Welcome to This Explainer. Today we're diving into a really fascinating and honestly super counterintuitive concept about the roof over your head. Okay, imagine for a second you just opened up your favorite real estate app. So, think you actually own your home? It's a pretty bold question, I know, but it really challenges what the sources we're looking at call the ownership illusion. Heading into 2026, home inflation isn't just some fun, theoretical number you get to brag about at a dinner party. According to the analysis we're exploring, that inflated price tag effectively translates into a mandatory monthly rent check. And you're writing that check directly to the government. It totally reframes how we look at the ultimate American dream, owning a home free and clear. To really wrap our heads around this, we're pulling from the insights of a CPA named Brian. He hosts a show called Hidden Tax, and he paints a really vivid picture here. Quote, "Even if your mortgage is zero, the tax man never truly moves out." Brian argues pretty passionately that true absolute ownership is essentially a myth. Why is that? Well, because local governments continually hike up property taxes based on these newly inflated home prices. So even if you've paid off the bank entirely, your financial obligations to the local government are tied to a market value that you literally have zero control over. Section 1. The Silent Siphon, a macro perspective. Okay, let's dive into this macro view so we can really grasp the urgency behind this tax squeeze. And that brings us to this absolutely staggering number, $39 trillion. That's the current national debt highlighted in Brian's analysis. Now we're looking at this totally impartially just to understand his argument. His stance is that with a $39 trillion debt hanging overhead, the government at various levels is, quite frankly, addicted to your tax dollars. They have massive liabilities, and they desperately need continuous, growing streams of revenue to service those obligations. So your home's rising value, it isn't just a win for you, it's a vital revenue mechanism for them. The source actually characterizes the government's strategy as ignoring the daily economic theater, the stock market ups and downs or the political talking points. Instead, they rely on this very quiet, very effective mechanism. Rising valuations act as a silent siphon. Think about it. You don't write a lump sum check for your equity. Instead, your monthly tax burden just quietly creeps up year after year, slowly siphoning away your resources right there in the background. Section 2. The equity drain math. Now, what's really interesting about this is how the math actually works against your primary residence if you aren't paying close attention. To understand the math here, we first have to master an absolutely vital financial concept: unrealized gain. Basically, this is an increase in the value of an asset that hasn't been sold for cash yet. And honestly, this is the crucial disconnect. When your house goes up in value by, say, $50,000, you don't suddenly have $50,000 sitting in your checking account to go buy groceries or pay the electric bill, right? It's strictly money on paper. But, as we're about to see, the tax bill that follows is charged in actual liquid cash. Here's the sequential trap laid out perfectly. Step 1. Your home value jumps 10 to 20%. Again, sounds amazing, but that inevitably triggers step 2. The county reassesses your property at this new, much higher value, which drops you right into step 3, a painful increase in your monthly tax bill. So you're now forced to pay higher taxes out of your current income just to cover a gain that you haven't even cashed in on. It literally turns a seemingly great market boom into a monthly cash drain. This leaves you with a really painful paradox. On the one hand, you have the illusion. Your net worth goes up, you feel great, you look fantastic on a spreadsheet. But on the other hand, you have the harsh reality. Your actual cash flow goes down. You have less money in your pocket at the end of every single month. Like our CPA source points out, you are essentially paying rent on equity that you can't even spend yet. Section 3. Building your fortress. So the crucial point is, we need to look at the specific defensive strategies detailed in the source material to actually protect against this squeeze. Alright, here are the actionable tips straight from the Hidden Tax script to make sure home inflation doesn't bankrupt your future. First up, challenge property assessments. You do not have to just accept the county's first offer. You can, and absolutely should, appeal if they overvalue your home. Second, own assets they can't print. The idea here is to diversify your wealth into tangible things that are insulated from simple fiat inflation. And third, nickel and dime every single deduction. Leave absolutely no legally allowable tax deduction on the table. You really have to aggressively protect your margins here. The ultimate goal of all these strategies really boils down to this one simple idea: keep the math in your favor. This is all about making a fundamental shift outlined by the source, moving from just being a passive participant to proactively protecting your wealth. By challenging those assessments and rigorously managing your deductions, you're taking control of the variables that you actually can influence. Which leaves us with one final, totally vital question to consider today. How will you defend your primary asset? Knowing what you know now about the ownership illusion, the silent siphon, and the harsh reality of unrealized gains, what's your next move going to be? I highly encourage you to pull up your latest property assessment, run the math for yourself, and see if it's time to start building your own financial fortress. Thanks so much for joining me for this explainer, and remember to always keep asking the right questions.